Hello and welcome everyone. If you want to go ahead and make sure that your microphone is working and your video is working as well, make sure you can see us. And if you want us to see you, that is working. If you're having any difficulties, feel free to either speak up or use the chat box and I can help you out. All right, and it is 2:05, so we're going to go ahead and get started as well. We wanted to welcome you all today. We have David and Juliana with us for closing the books. Before we get started, Jessica is going to give you guys just a few heads up of some things that are coming up as well.
Good afternoon, everyone. Thank you for joining us for the class today. Today we have Clark Huber presenting Closing the Books. We're going to go over the monthly closeout, bank reconciliation, and so forth. So that's going to be another great class to have. Also wanted to let everyone know that as part of the EP program participant, it is your benefit that we will provide any sort of marketing assistance, credit repair, or if you need a bookkeeping services or CPA to look at your books. Please contact Lily or myself so we can get you connected. Thank you.
All right, David, if you'd like to go ahead and reshare your screen, we'll go ahead and get started.
Okay, can you see my screen?
Okay. Yes, we can. Great.
Welcome, everybody. Today we're going to talk about closing the books on a monthly basis. So I've been with Clark Huber for 5 years. I was in the audit department for about 2.5 years and moved over to the accounting and consulting services side. I've been there for about 2.5 years as well. Juliana, want to make an introduction?
Yeah, my name is Juliana D'Angelo, and I work with David. We've been working alongside each other for almost 3.5 years or so. And I actually also started my career as a financial statement auditor way back 15 years ago or so. And then I've spent quite a few years out in industry working at various real estate firms and other industry type jobs. And I've been doing consulting for the last 7 years or so. And I'm really excited to be here.
Okay. So the ABCs of the monthly close process, accounting departments or the owner, whoever's doing the books, must reconcile the books with supporting documentation to ensure the statements are correct, the balance sheet and the profit and loss statements. Management uses these statements to make decisions and also to look at the budget versus actuals. If you have a budget for the year or for the month or for whatever period. And if these financial statements aren't completed accurately or on time, management can lose valuable tool needed to smartly run your business. The timing for the close process, we recommend to close the month as quickly as possible. You can make it quicker if you integrate everything together, streamline, create rules in the accounting system. For example, like QuickBooks, you can create rules in there for banking transactions, so you don't have to post manual entries all the time or post any adjustments. And it's important for that companies have standard monthly close procedures, which include like a checklist and a strict timeline for completion. The close process, pretty much, so you reconcile the bank accounts, the checking and savings account, record any bank transactions that haven't been added. For like QuickBooks, you can sync or link the bank account to QuickBooks Online, so you don't have to manually enter each transaction. And reconcile balance sheet accounts, for example, AR, which is accounts receivable, prepaid, fixed assets, accounts payable, and other accruals and liabilities, for example, like loans, accrued interest on mortgages, things like that. And other procedures is count inventory. If you have an inventory, you sell any products, and review the financial statements, which are the balance sheet and the P&L. Accrual versus cash method of accounting. I think we talked about this in the first class. So the accrual method, it's revenue is accounted for when it is earned and not when the cash is received. Unlike the cash method, the accrual method records revenue when a product or service is delivered to a customer, with the expectation that the cash is going to be received later on. Expenses of goods and services are recorded despite no cash being paid out yet for these expenses. So pretty much accrual method is when the services are provided or earned. Cash method of accounting is pretty much when cash comes in, that would be revenue, and when cash goes out, that's expenses. And here's a basic table that explains each method. So cash basis for revenue is when cash is received, and for expenses, it's when it's paid. Accrual basis, revenue is earned, is recorded when earned, and expenses is when it's incurred. If you use QuickBooks, you can easily change your accounting method. Let me share my QuickBooks screen. Just going here, you can go to settings, account settings, and go to advanced. You see the accounting portion right here. You can change the accounting method from accrual or to cash, whatever method you want to use. You can change anytime you want. Okay, let's go back to the PowerPoint. So a poll question. Heather, can you pull this out? I'll read the question. Craig provided landscaping services on August 15th, 2020 for $200, and payment wasn't received until September 23rd, 2020. What month should Craig record revenue on an accrual basis of accounting? So A, August 2020, B, September 2020, C, December 2020, or D, July 2020.
All right, we have about 60% of people who voted. I'll give everyone just a few more seconds to decide, and then I'll go ahead and close the poll out and share those results. All right, the poll has ended, and those results are up there on the screen.
Okay, thanks, Heather. So the answer for this one, since it's on an accrual basis of accounting, you record revenue when it is earned. Since the services were provided on August 15th, 2020, revenue should be recorded in August since it's on an accrual basis. If it was on a cash basis, revenue will be recorded in September when the cash was received. Next, we're going to talk about reconciling the bank account. So pretty much a bank reconciliation is a process performed by companies to ensure that the check register and the balance in your accounting software is correct, or on the balance sheet is correct. Reconcile your statements monthly to what is recorded in the books. Any missing transactions that haven't been posted to the accounting books or accounting records need to be posted. Review outstanding checks and deposits to see if it's current, if it's accurate, or if it's going to clear. Sometimes I have clients that have outstanding checks for a year or 2 years, and it's never going to clear the bank. For those, we recommend our clients send those to unclaimed property. And for outstanding deposits, you would need to check where that check or cash is, or if it needs to be written off if it was never received, or maybe follow up with the customer or the client for payment. Bank reconciliation process. First step, pull the bank statements, ensure all bank transactions have been posted. QuickBooks banking module, you can add and match what's in the books. You can create rules as well, so you can automate and streamline the process. For example, if you have like a recurring monthly fee for, say, internet, you can create a rule for that, so you don't have to post it each month. Perform bank reconciliation in your accounting software, QuickBooks or Intact or whatever you use. Review for any unclear transactions, like I mentioned before, outstanding deposits and checks. So here's a format for bank reconciliation. So pretty much you start with a bank statement balance at month end. Add any checks deposited but haven't been recorded in the bank. These are like checks that were deposited on, say, August 31st. So you went to the bank, deposited a check, but it didn't clear the bank until September 2nd. Sometimes it takes a few days to clear the bank. Then there's any other adjustments, maybe refunds and things like that. Next, you minus checks issued but haven't been cashed yet. So these are outstanding checks. For example, you wrote a check on August 15th, 2020, and when you reconcile the August bank statement, the check hasn't cleared yet. So this is going to be an August outstanding check. And then you get your balance as per QuickBooks or your accounting software. Here's an example for a bank reconciliation, just a simple one. Craig's Construction Company has a balance on the bank of $1,000 on March 31st, 2020. A check of $300 was deposited but didn't clear or get recorded by the bank until April 2nd, 2020. And a check worth $20 was issued in March but not cashed yet. So you can see here on the left the table. So we start with a bank statement balance of $1,000. You add the outstanding deposit of $300. Then you subtract the outstanding check of $200, and that equals $1,100. So this balance right here should show up on your balance sheet of the amount of cash on hand, or your actual cash balance. Here's another poll question, Heather. Pull that up. I'll read the question. How often should you reconcile your bank accounts? A, weekly, B, daily, C, quarterly, or D, monthly?
All right, we're getting a few responses. Wait just a few more seconds here. Give everyone about 10 more seconds to put in their response. We're only at 42%, so someone else needs to click. Okay, I'm gonna go ahead and end the poll here and share those results.
All right, thanks, Heather. So how often should you reconcile your bank accounts? It'll be monthly when your statements come out. Most majority of statements are monthly. Bank statements, credit card statements come out monthly. Next, let's talk about undeposited funds. So these are pretty much cash or checks received that haven't been deposited to the bank yet. So these could be cash or checks in your drawer or in your office and you haven't walked to the bank or deposited it yet. Create a schedule of these cash and checks and their location if applicable. QuickBooks has a nice schedule showing what checks have been deposited or not, and make sure this is up to date. Some of my clients accidentally record a deposit in QuickBooks and they don't match it to the undeposited funds. So some of these undeposited funds sit there for a while until it gets cleaned up. Ensure deposits are made timely. create some process like make deposits daily or weekly. Just don't let the cash sitting around for too long. It's a risk of fraud or loss. Accounts receivable. Accounts receivable is money owed to your organization for services or products sold. Shows up as an asset account on the balance sheet. An example of accounts receivable includes a landscaping that bills its clients after the clients receive the landscaping services. The company records an accounts receivable for unpaid invoices as it waits for its customers to pay their bills. Pretty much these are unpaid bills from customers. So AR, just make sure your invoicing is up to date and current. If you're slow on invoices, you don't collect cash. Pull the detail AR aging report when you're doing your monthly close. Review for any old or unusual balances. Look for the old balances, like this table here. You can see at the very top, there's a balance from Red Rock Diner for $156. It's 61 to 90 days past due. Maybe reach out to the customer, see if, when they're going to pay. And if you guys agree that they're not going to make payments, possibly write it off. And the ones that are getting close to past due, follow up with those customers as well. Inventory. Inventory is an item that your business has bought with the intention of reselling to customers. Examples include shovels, tools, wood, snacks, food, cleaning supplies. Keep record of inventory on hand. Perform a physical inventory count, at least on an annual basis, and make sure you correct your accounting records to match the inventory count. Because sometimes there could be stolen or lost inventory items, or expired or obsolete or defected items. So you need to correct your inventory balance to what was physically counted. Fixed assets. Fixed assets are purchased for long-term use, usually over a year, and are likely to be not likely to be converted quickly into cash. Examples include land, buildings, and equipment, trucks, vehicles, things like that. These fixed assets are subject to depreciation. Fixed assets, so add in or dispose assets. We're going to talk about that. Sell an asset, recording the gain or loss on sale. Talk about a capitalization policy. We'll go over an example. And also review the P&L detail for any items that can be classified as a fixed asset.
If I could jump in really quick, I think a lot of times your fixed asset policy is largely determined by what your tax professional recommends because of the size of your business. So when you grow, and you have full out GAAP accrual financial statements that have large audits performed on them, that's a little bit different. But when you're mid-size, I think sometimes you can postpone tracking fixed assets until the end of the year, which can be a little problematic. So I would recommend establishing a policy that's consistent with what your tax professional recommends, and then following that. And then also just doing, like he says, reviewing your detail of expenses to pull out anything that might reach that capitalization threshold, whether it be computers, printers, or large machinery that's used in some of your jobs. A lot of that can be capitalized and should be, and then that way you're representing books that are more in line, and you're not having to make all of these adjustments every year to move them from tax and depreciated books to not depreciated books. So I would recommend kind of establishing that policy as early as possible, and then it's a lot easier to kind of carry out throughout the year, and then make sure that it's consistent with your tax record. Thank you.
Yeah, thanks. So here's an example of a capitalization policy. So this company capitalized assets with a cost greater than or equal to 2,500 and an estimated useful life of 1 year or more. Depreciation is computed on a straight line basis following the estimated useful lives. So furniture, fixtures, and equipment, 7-year useful life on a straight line method. Leasehold improvements could be 3 to 20 years, depending on the improvement. Tools, 3 years. Vehicles, 5 years. Computers, 5 years. So this is an example. Talk to your tax professional about your policy. Like for this one, so anything over 2,500, that is a fixed asset, will be capitalized. Anything below, we won't consider to be capitalized because it's under our threshold, and that would just be expense in that period or that year. Depreciation. So during each accounting period, year or monthly or quarterly basis, a portion of the cost of these assets is being used up. Portion being used is reported as depreciation expense, which is on the income statement or the profit and loss statement. To illustrate, here's an example of depreciation and how to post it to your accounting system. So on July 1st, 2018, the company purchases equipment with a cost of $10,000. The company estimates that the equipment will have a useful life of 5 years. So you can see on that table on the left, so we have 10,000 for depreciable cost, divide that by 5 years, and the depreciation expense per year will be 2,000. On the table on the right, you can see these are all the journal entries that we posted to the accounting system. So the first one, you can see December 31st, 2018, only 1,000 of depreciation is being recorded as a depreciation expense to the P&L. The reason for that is because we purchased the equipment on July 1st, which is halfway through the year. So we only are depreciating half of it. So 6 months of it, which is half of 2,000, which is 1,000. Then from 2019 to 2020, we're depreciating 2,000 per year since we're getting a full year's worth of use. Then at 2023, you can see that we're only capitalizing 1,000 or depreciating 1,000 since it's only 6 months that the asset's being depreciated for. So in total, depreciation expense is 10,000 after the 5 years. Yeah. This is another poll question. Heather, you can pull it up, and I'll read the question. Craig purchased a truck for $50,000 on January 1st, 2020, and he estimates the useful life of the truck is 10 years. How much depreciation expense should Craig record in the year 2021? A, 50,000, B, 10,000, C, 5,000, D, 1,000.
All right, I'll give everyone a few more seconds here. And if you aren't sure of the answer, just go ahead and give a good guess. We will be talking about it after I close out the poll. Your answers are anonymous as well, so give everyone a few more seconds here. All right, I'm going to end the poll and share those results.
Okay, so I'll read the question again. Craig purchased a truck for $50,000 on January 1st, 2020, and he estimates the useful life of the truck is 10 years. How much depreciation expense should Craig record in the year 2021? So you purchased a truck for $50,000 and it's been used, the useful life is 10 years. So we go 50,000 divided by 10 years. So it'll be $5,000 being depreciated each year. So the answer is C here. Next, we're going to talk about fixed asset disposals. So the disposal of assets involves eliminating assets from the accounting records. This is needed to completely remove all traces of an asset from the balance sheet, including accumulated depreciation and the actual fixed asset, and record any gains or losses on the sale of the vehicle or disposal of the vehicle. Accounting for the disposal of fixed assets. So if no proceeds were received and it's fully depreciated, the journal entry will be debit all accumulated depreciation and credit the fixed asset. If there was a loss on sale of the asset, you debit cash for the amount received, debit all accumulated depreciation, debit the loss on sale of the asset account, and credit the fixed asset. Now there's examples on the next page, and I'll talk about that. Gain on sale, debit cash for the amount received, debit all accumulated depreciation, and credit the fixed asset, and credit the gain on sale of that asset account. So here's some examples. So example 1, Craig Landscaping buys a machine for $50,000 and recognizes $5,000 of depreciation per year over the following 10 years. At that time, the machine is fully depreciated. Craig gives it away and records the following entry. So Craig gives it away for free. So pretty much we write off the asset and the accumulated depreciation. So accumulated depreciation is a credit balance on the balance sheet. So you debit that account, so accumulated depreciation is $50,000, and reduce the machine of $50,000. And the machine was an asset account. Since we're disposing of it, we credit that account to eliminate it from the balance sheet. Example 2, Craig sells a $100,000 machine for $35,000 in cash after having compiled $70,000 of accumulated depreciation. And the entry for this is, so you debit cash, so you receive cash of $35,000. Accumulated depreciation was $70,000, so we clear that out. You get rid of the machine, which was $100,000, and the gain on sale of the asset was $5,000. So we got cash of $35,000, accumulated depreciation. So total of that is $105, and the gain on sale of the asset and the machine asset is $105. So you can see the debit and the credits balance here. Yeah. Example 3, Craig sells another machine that had originally costed $40,000 for $25,000 in cash. The company had compiled $10,000 of cumulative depreciation on the machine. The entry is the following. So received $25,000 in cash. $10,000 was recorded for cumulative depreciation. Then you get rid of the machine on asset of $40,000, so you credit that, and the difference is a loss on asset disposal of $5,000. So pretty much the net book value of the machine asset when it was sold was $30,000. So $30,000 minus the cash received, a difference of $5,000 to record as a loss on asset disposal.
And this is why it's important to keep really great fixed asset records, because these entries might look a little complicated, but really you're just taking that asset value down to zero, taking the accumulated depreciation down to zero, recognizing the cash, and that offset is going to be a gain or loss. So it's a fairly simple entry if you have really solid depreciation records.
Here's another poll question. Craig sells a vehicle that had originally cost $25,000 for $7,000 in cash. The company had compiled $25,000 of accumulated depreciation on the machine. How much is the gain or loss on sale of the asset? A, gain of $2,000. B, gain of $7,000. C, a loss of $25,000. Or D, loss of $2,000.
All right, I'll give everyone a few more seconds here to give their responses. And again, your answer is anonymous, so we can't tell who's answering what. So just give your best guess if you aren't sure. And then we will be talking about this after I close the poll. Give everyone about 10 more seconds. All right, I'll go ahead and end the poll.
Okay, I'll read the question again. Craig sells a vehicle that costs $25,000 for $7,000 in cash. The company had compiled $25,000 of depreciation on the machine. So the net value of the machine when it was sold was pretty much zero. So 25,000 cost minus the accumulated depreciation, and they sold it for 7,000. So that's a $7,000 gain. So the answer for that was B. So here's the answer and the journal entry. So you can see here we debit cash of 7,000 for the cash received. We get rid of the accumulated depreciation on the vehicle. So we debit that, and we credit the vehicle of 25,000, and the difference is the gain on asset disposal, which is 7,000. Next, let's talk about prepaid expenses. So prepaid expenses are an expenditure paid for in one accounting period, but for which the underlying asset would not be consumed until a future period. When the asset is eventually consumed, it is charged to an expense. So prepaid expenses is an asset account on the balance sheet. If it's consumed over multiple periods, there may be a series of charges to an expense. For example, health insurance. If you prepaid health insurance for a year, you will record monthly health insurance expense, amortizing it over the 12-month period for the health insurance service. So here on the screen on the right, the table on the right, so this is an example of a prepaid schedule. So you can see here that first column, car insurance. So the starting balance or the purchase price of the car insurance was $500. And it was purchased in January. So it says the first period is 1. And the duration of the service or the policy was 11 months. So pretty much you do 500 divided by the duration period, which is 11 months, which you get a cost of $45.45. So over the course of the 11 months, starting from January, you recorded an expense, insurance expense or vehicle expense, $45.45 evenly throughout the 11-month period. Another example, property taxes. You can see the second column, 25,000 was purchased for a duration of 15 months, starting in the 5th month, which is May. You can see here when you do 25,000 divided by 15 months, you get about $1,666 per month of expense. So you can see there the amortizing cost per period. You can see here it starts in May, the 1,666. It goes through the end of December. If this spreadsheet was longer, it will go through another, let's see, another 7 or 8 months when the property taxes duration period ends. Another example, subscriptions. This is pretty common. Duration period is 12 months. First period starts in September. So you can see here, $1,250 gets expensed on a monthly basis, and it rolls through to the next year until August of 2017, which is a 12-month period. To find any other prepaid expenses, review the profit and loss statement with expenses to see if there's any transactions that could be reclassified to a prepaid expense and amortized over multiple periods or multiple months. Here are some examples. So subscriptions, like we talked about, insurance is common, property taxes, any annual memberships, associations, and things like that. Here's our prepaid example. Craig's Landscaping Company purchased insurance for the upcoming 12-month period. Craig pays $120,000 upfront for the insurance policy. So when he first pays for the policy, the entry is credit cash going out, and you debit prepaid expense, which is an asset account on the balance sheet of $120,000. Each month after or during the service period, an adjusted entry will be made to expense $10,000 each month. So that's pretty much 1/12 of the $120,000 that was prepaid for. And this gets expensed to the income statement. And this journal entry is a credit to prepaid insurance and a debit to insurance expense. In the 12-month period, the final $10,000 will be fully expensed, and the prepaid account will be zero. You can, instead of posting these entries manually, your accounting system or some accounting systems can manually create these journal entries for you. And I'll show you an example in QuickBooks. You can create rules to streamline the process. So here's our Craig's Design Landscaping Services sample company that we've been using. For recurring transactions. So you can see here, let's see, let's create new. Let's create a journal entry. So you can say prepaid insurance. Let's go for 2020. Create days in advance. So this would be create 1 day in advance of the journal entry interval. So we're expensing this monthly on a monthly basis. And let's start in, say we purchased the insurance in January. Let's start at the first entry, January 31st, 2020, and end at the end of the year. So we see here we debit insurance expense. So insurance expense of $10,000. Then we credit prepaid. So we don't have. So I can create a prepaid accounts real quick. There's no prepaid accounts in this sample company right now, but I can create one. It's a other current asset. Let's go prepaid expenses. Let's go prepaid. Okay. Click Save Template. Can't be for today. Okay. Let's just go, for example, start October 1st and end September 30th, 2021. So doing this recurrent transaction, I don't have to manually go into your accounting system or QuickBooks and post that entry on a monthly basis. It just streamlines things and makes your monthly close a lot more efficient. Here's some other examples of prepaids. Company pays $60,000 in advance for software subscription for the upcoming 3 months. The journal entry is we debit prepaids $60,000, credit cash $60,000. At the end of each period, the company amortizes the prepaid expenses with the following journal entry. So you debit software expenses and you credit the prepaids account. So you do this for 3 months, and after the end of 3 months, the prepaid expenses will be gone, and the software expenses will be $20,000 allocated through each of the 3 months that the service or the subscription was provided. Here's another poll question. Craig paid $12,000 for a 12-month gym membership for his employees. Craig recorded the $12,000 to prepaid expenses at the time of purchase. How much should Craig record as an expense each month? So 12-month gym membership for $12,000. So A, 12,000, B, 500, C, 1,000, D, 2,000.
All right, I'll give everyone a few more seconds. And I'll go ahead and close out the poll. Like I said last time, your answer is anonymous, so just give your best guess, and then we're going to talk about it after I close the poll. All right, 5 more seconds. 3, 2, nobody else? Okay, I'm ending the poll now. Sharing the results. There you go.
So Craig paid $12,000 for a 12-month gym membership. So pretty much 12,000 divided by 12 months. So that's $1,000 per month. So the answer is C. So you debit gym membership expense or fees for 1,000, and you credit prepaid expenses each month. Okay, let's talk about accounts payable. So AP, ensure all your bills are received and entered in the system as soon as possible when you receive them. Pull a detailed AP aging report, which is a snip on the right. Review for any old or unusual balances or any debit balances, which are negative balances, and determine if any should be written off or paid. So for like the old balances, for the one at the top, PG&E, you can see it's 41 days past due right here, an amount of $86.44. Just think about like why this hasn't been paid. Is it because your AP team is slow, or maybe you're negotiating a new deal with them to lower the amount, or whatever it is? Just make sure you're up to date on this vendor, or just aware that this bill is still outstanding. Sometimes there's negative balances, also known as debit balances. Sometimes you overpay a vendor on accident. If you have any of these, talk with the vendor and see if it can be applied to the next invoice, or you would like a refund. Credit card and debt. So you do bank reconciliations for these as well, for the credit cards. So you pull bank statements similar to the checking and savings account, pull transactions and connect the bank to the banking module and to the accounting software or QuickBooks, whatever you use. Perform reconciliations and look for any outstanding or outstanding checks or outstanding transactions or payments or refunds. Usually there shouldn't be any outstanding payments or refunds because there's usually whatever clears the bank is what needs to be reconciled. Yeah, pull the recon summary and detailed reports after you have reconciled. Employee credit cards. Ensure employees are submitting their expenses and receipts on a timely manner. If you have employees with credit cards, make sure you have an expense policy or credit card policy, saying like they need to have proof of receipts for each transaction or whatever you agree upon. Ensure expenses are reviewed by the managers of the employees to ensure there's no personal expenses on these credit cards, and that they're not abusing the credit card. And there's expense tracking softwares out there that you can use. Expensify, Concur, Center Card is a new one, and these streamline your monthly close. Expensify syncs, all these three sync with QuickBooks to streamline the close process and getting away from manual entries. Customer security deposits. Customer deposit is cash paid to a company by a customer for which the company has not yet provided goods or services in exchange. So these are a liability balance on the balance sheet since you haven't earned it yet. So you need to keep a schedule of which customers have security deposits, and able to determine when security deposits will be returned or applied to a future invoice for planning purposes and cash flow. Loans. So loans show up as a liability on the balance sheet. These are the principal balance of the loan. So loan liability balance should be the principal balance excluding interest. Sometimes you will need to accrue interest if you haven't paid for the interest, or if you're behind on the interest and you still owe it. And if interest is paid quarterly or annual basis, you need to accrue it on a monthly basis to show that you owe that interest. Examples of loans include like mortgage payments. So principal payments reduce the loan liability balance, and the interest portion is interest expense on the P&L. How to record loan payments, which include paying both interest and principal. Loan statement is likely to consist of three amounts: total payment amount, interest payment, and principal payment. Generally, the interest payment is related to the principal amount that is owed to the lender. So when a principal payment occurs, the balance of the principal amount owed will decrease, which will decrease your interest payment. Will be smaller in the next the mortgage payment or loan payment. So the lower the principal balance, the lower the interest. Heather, should we take Q&A right now? It's a good time.
Yeah, we can definitely do that. We do have a few here. And then we can go ahead and take our break afterwards as well. So the first question that came up was, she was asking, what was the statement about sending something to unclaimed properties? I think that was way back in the beginning, hopefully.
Yeah. So Washington State, I'm not sure how often, I think you're supposed to file every year of any unclaimed property. So for example, pretty common are like outstanding checks or payroll checks that haven't been cashed by the employee or previous employee. So usually these sit in outstanding checks, but Washington State has a policy to send those to them, and then the employee can go to the state to see if they have any unclaimed property. I think that's the employers need to file that on a yearly basis, I believe.
Yeah. The company would, in theory, review all of their outstanding checks, and if there are any that are over a year old and they haven't been cashed yet, they need to make a sincere effort to follow up with the individual who received the check to try and get them to cash it or reissue the check. And if they can't, there's a series of steps they go through to submit those uncashed checks to unclaimed property with the Department of Revenue. So if you just look up the Washington State Department of Revenue, if you Google unclaimed property, it'll like bring you right to the site, and you can look up to see if you have any unclaimed property, but also that's where you would go about filing your unclaimed property. And I actually believe it's due the end of October every year. So just something to think about if you have any really, really old checks on there. At some point, you need to make sure, or you need to try and get those to the owner. You can't just really like write them off and say, oh, they forgot about them. So just another step to go through.
Any other questions, Heather?
Oh, yeah, I'm sorry. My phone wasn't working there. So the next one is, how would you depreciate a building that you do business in?
Do you want me to take this?
Yeah, sure.
It's still a building that you own. So you would figure out the useful life of that building based on the fixed asset methodology that you have in place, and it's usually like 30 years. And then you would break it up over that 30 years and depreciate a little bit every month, just to sort of be booking that expense to match the value that you're getting from it on a monthly basis. So again, check with the tax professional to see what their recommended depreciation year would be. But yeah, just like you would depreciate a copy machine.
All right, perfect. Thank you for that. The next one is, what's the significance of depreciation in relation to financial statements? Does it lower your profit in a good year?
Well, that's a really good question. The idea of depreciation is to match the value that you're getting from that purchase over the useful life of that purchase. And so if you buy a vehicle and you expect you're going to get good use out of it for 5 years, then you would in theory depreciate that over 5 years. So you're spreading that expense out over 5 years. Sorry, my daughter just popped in here. And so you spread that out over that 5 years, and then it would show up on your income statement kind of below. So it's not really a cash expense, it's considered a non-cash expense, but then that flows into your tax return, and it does reduce your taxable income. However, it's a limitation because it's actually forcing you to take that expense over the course of like 5 years. So a lot of companies would love to be able to just take all of that cost out in the first year. If I spent $30,000 on a vehicle, I would really love to take that hit now so I can get the tax benefits of having $30,000 less in income. But unfortunately, I think that's why a lot of the mandates around depreciation exist. So you would spread that out, and it would actually, it actually increases your income because you are spreading out that expense over the course of 5 years instead of taking it all at once. Does that make sense?
I can wait for a response for that.
Yeah, it's worth discussing more if it's a confusing concept.
Yeah, and if I want to see, let me see if I can scroll back and find out who did. If they want to go ahead and speak up as well, you can. And then Juliana can explain that a little bit better. I'll go ahead and move to our next question while we're waiting there.
Sure.
The next one is, if I paid for software for a year, wouldn't I note it as a full payment for the $12,000 when I write the check?
I think that's a fabulous idea. Any information that you can put in that memo is going to help you, even like January through December 2020, so you know that it's the contract period over that 12 months. Because that way, when you go to look up that information later, you can remember what the period that it was. And then when you're transferring that data onto your prepaid schedule, if it's necessary, you have a prepaid schedule, then you'll have the information right there without having to sift through invoices. So the more information that you can put on the check, the better.
All right, awesome. And that was our last question for right now. If there's anyone that's in our audience that wanted to ask a quick question, you are more than welcome to type it in the chat, or if you select the participants box down at the bottom, it will pop out all of the participants, and then you should be able to see the raise hand feature there. And if we don't have more than one, you're also just welcome to unmute yourself and go ahead and ask your question. I'm not seeing anything come through just yet. So if we do, I'll go ahead and call them out. David, did you want to continue, or did we want to go ahead and take our break now?
Let's take a break now. That's a good time.
Okay. Perfect. We'll go ahead and take a 10-minute break, everybody. If you want to go ahead and meet us back here at 3:10, we will see you in a few minutes. All right, everybody, welcome back from break. If you guys could just let us know that you're back by either sending us a chat using one of the reaction buttons located on the bottom bar, or you can use the green yes check mark, which is located underneath the participants tab. Once everybody kind of filters back in, we get some responses, we can go ahead and start. And to start us off, Jessica does have a few words she'd like to share with everybody.
So thank you, Heather. So later on, before the class end, we're going to have a drawing. So make sure everyone stays until the end, and then we'll announce it. The person is able to get some free marketing materials with your logo imprinted on it. So don't miss it. And also we wanted to increase the synergy of the group. So starting Thursday's class, we are going to have each one of you or anyone who's interested do a brief introduction about you or your firm. I think that this group has a lot of expertise and knowledge that can be shared among the group. So we wanted to create that synergy here and then have all of you be familiar with each other and what you do. Thank you.
All right, awesome. Thanks, Jessica. That all sounds really fun. I did just get a notice that Juliana is going to do some practice questions with everyone as well. So if everyone kind of wants to let us know that they are back, we'll go ahead and get started.
Okay.
Yep, go ahead. I was going to say we're getting a few responses, so go ahead and get started.
Okay. So let's go through an example of loan payment real quick, and how to record that in the books and the journal entry for that. So let's assume that a company has a loan payment of $2,000 consisting of interest of $500 and a principal of $1,500. To record this loan payment, you would debit $500 to interest expense, debit $1,500 to loans payable, which reduces the loan payable balance on the books, and credit cash for the payment going out. The credit balance in the company's liability account, loans payable, should agree with the principal balance on the mortgage statement. So usually when you get a mortgage statement on a monthly basis, it has a principal balance left. So that should match what your loan payable balance on the balance sheet. Still a quick poll question. Craig Landscaping has a principal mortgage of $100,000 as of March 31st, 2020. Craig makes a payment of $5,000 on April 15th. That consists of $3,400 principal and $1,600 interest. What should the loan liability balance be as of April 30th, assuming no other payments were made in that month? A, 96,600, B, 95,000, C, 100,000, D, 98,400.
All right, we're getting a few responses come in. I'll give everyone just a little bit more time. Please keep in mind that your response is anonymous. So if you're not sure, just go ahead and give us your best guess. And then after I close out the poll, we're going to discuss those answers. All right, give everyone about 10 more seconds. There's a few people who haven't voted yet. All right, I'm going to go ahead and close out the poll and share those results.
Okay. So the question was, what should the loan liability balance be as of 4/30/2020? Since the mortgage balance was 100,000 and a loan payment with 5,000 was made, and 3,400 of that was principal. So we subtract that 3,400 from 100,000. That should be 96,600 should be your liability balance as of April 30th, 2020.
And then that $1,600 that will get booked to an interest expense in
Correct.
your payment entry.
Financial reporting. So after you've done all the bank reconciliations, creating your spreadsheets, and reporting for prepaid, fixed assets, accounts receivable, AP, and things like that, you pull a balance sheet, tick and tie to those work papers. For example, so when you pull a balance sheet, it shows up the cash balance shows up, prepaid balance shows up, fixed assets, accounts payable, accounts receivable. So you tie that or make sure that amount matches your supporting documentation, your supporting work papers. If it doesn't, you need to figure out why it doesn't and try to resolve that discrepancy. Also, pull up profit and loss statement, perform flux analysis on a monthly P&L. So pull the current month and compare it to previous months, see if there's anything that stands out, that anything that fluctuated high or low, and try to figure out why and try to understand your profit and loss statements better, and get a better understanding of it. Yeah. Any other thoughts, Julian, on that?
Yeah, I mean, really, what David went through for this last hour and a half or so is the importance of understanding what is actually in your accounting software, especially at month end. So when you pull something like a balance sheet, which we're going to go over next week, or an income statement, and you're like, what is in this account here? What is in prepaid expenses? You can look at your supporting documentation that you've been tracking and closing out on a monthly basis and know exactly what's in there. So you don't have to do research or pull data together. The idea is that you're maintaining these records on a monthly basis, so you have comfort that all of the balances that are on your financial statements actually are accurate and mean something, and you have validity and some documentation to support all of those amounts. So just kind of bringing in the whole thing. That's sort of the idea behind a month-end close process. Is, I mean, really, you can just be doing whatever all the time and cutting your checks and recording your credit card transactions. But if you just continually let that go and you never actually close out and reconcile to make sure things aren't doubly recorded or to make sure you've captured all the activity that's happening, your financial statements aren't going to tell an accurate story. And that's what's important, is you being able to rely on those financial statements and the owners of the company being able to rely on those financial statements. And usually the best way to start to pull together this information is just an Excel workbook. Just start to detail out what's in there. Pull a report from QuickBooks, which David will walk you through in a little bit. And if it doesn't match up, then figure out why and clean things up. So it really provides a good opportunity to make sure that your accounting records are shipshape.
Yep.
So with that, maybe I will take over, and there's also a question about going over credits and debits, and I've got some information for that. So actually I'll go into the credit and debit right now. Let me share my screen. Take me a second to get this situated. I'm so sorry. Sorry about that. Okay, so debits and credits. When recording items in an accounting system, there needs to be two sides of every entry, and it's going to change. You're going to book a debit or a credit based on what the account that you're hitting is. So there are assets and liabilities and stockholder equity accounts, and then there's the profit and loss statement. So all of those accounts have like a normal balance, which is a debit or a credit. And then when it increases, you would hit that normal, a debit. And if it's decreasing, you'd hit like the credit if the normal balance was a debit. And that's kind of how you track the ins and outs of all of your accounting numbers. And so the idea is that the best way to think about it is a lot of times they recommend setting up a T account, which, so this is an example of a T account. You put like cash on top of here. And the debit would be the left side and the credit would be the right side. And for cash, the debit is the normal balance. So anytime we debit cash, we're increasing cash. And anytime we credit cash, we're decreasing cash. And to do a journal entry, you got to have an offset. So if we are debiting cash to increase cash, then we have to credit something. I don't know what that would be, right? Credit revenue because we're getting cash in, or credit expenses if we're getting a refund on an expense, whatever it is. Everything needs to be in balance. You always need to have a debit and a credit, and it's going to affect that entry. The great thing about QuickBooks is if you book something to the wrong side, you can always go in and change it really quick until you get it right. But it's good to have this information kind of in the back of your head. So this is kind of like our balance sheet right here. We have assets equals liabilities plus a stockholder's equity. And again, we'll go over what the balance sheet looks like next week. But as you can see, assets always have a debit normal balance. So all of those assets, cash, investments, prepaid expenses, property, plant, and equipment, they're always going to have a normal debit balance, which means to increase them, you hit their normal, you debit, and to decrease, you hit a credit. And then liabilities are the opposite of that. They have a credit normal balance. So anytime you want to increase the liability, you're going to credit that normal balance, and then you'll debit to decrease the liability. And stockholders' equity, really, as you can see from this diagram, the profit and loss or the income statement kind of rolls into stockholders' equity. So anything, all of your revenue less your expenses gives you net income. And QuickBooks automatically takes that net income and rolls it into your retained earnings, which shows up right here on your stockholders' equity. So this is just like a really brief overview of sort of the relationship between the debits and credits and how they flow into those financial statements. So how those little journal entries that David was making in all of his examples today, this is how they eventually end up on the financial statements. So all of that being said, I'm going to run through another bank reconciliation example for you just to understand. Sorry, move this over here. Just to kind of gain an understanding of exactly what we're doing again, just because I know that there's a lot of struggle. The great thing about QuickBooks is they have a bank reconciliation module, and David's going to walk us through that after, but it's really helpful to kind of understand what we're doing. The idea is we're tracking the ins and outs of cash in our general ledger, in QuickBooks, when we're cutting checks, when we're making deposits, but we're not always catching everything. Maybe there's an ACH that's automatically taken out every month that we don't know how much it's going to be, so we don't see it until we get the bank statement. Perhaps there is some banking fees. Perhaps there is some interest earned on our bank account. They just automatically deposit it and we don't see it until the bank corrects. There's usually a few reasons why there would be a discrepancy. And then obviously our bank balance isn't going to account for checks that we've written that have not been cashed, those outstanding checks. And our bank balance is not going to account for deposits that we may have made right at the end of the month that haven't really hit that bank account yet. So those are called deposits in transit. So I just want to kind of walk you through why it's called a bank reconciliation, because really you're reconciling that bank balance to your general ledger. So the steps are: enter your cash balance per the bank statement, add in your deposits not recorded by the bank, deduct outstanding checks, and this will determine your adjusted bank balance. And then for our general ledger, we're going to do a similar type of reconciliation. We're going to enter in our cash balance. We're going to add in credit memos, which are not debits and credits. Credit memos on a bank statement are actually increases to your bank account. Deducted debit memos, which are like fees or maybe an ACH payment that went out. And then we'll determine our adjusted balance. And the hope is that those two adjusted balances will match. So here is a sample for us to work through. The accounting records for Delta Driving School show a cash balance of $14,134. So that's in our general ledger balance. So if we were to pull a QuickBooks report, balance sheet, and the cash balance says 14,134. That is our GL balance. On the evening of February 28th, the company receipts of 1,250 were placed in the bank's night deposit drop box. So that would be a deposit that we recorded in our general ledger, but if it's going in the night box, it's probably not going to hit the bank until the next day. The February 28th bank statement shows a balance of $18,877, including a collection of a $6,000 note receivable and $55 of interest earned, and a service charge of $40, and a $1,550 debit memo for the payment of the company's utility bills. So it looks like there's an ACH that went out, a payment that came in that we haven't recorded yet, and some fees and interest. And then all of the checks that the company had written during January were listed on the bank statement, except for check 1908 in the amount of 1528. So we've got one outstanding check. So the first thing we're going to do is we're going to start with the bank section, and we're going to enter the cash balance per the bank statement. So that is down here, balance of, move that up a second, so sorry. It'd be 18,877. And then we're going to add any deposits that weren't recorded by the bank. So those deposits in transit, and that would be that deposit that hit the night box. So 1,250. And then we will deduct any outstanding checks that aren't showing up on the bank statement. So that would be that one check 1908 for $1,528. So my, move this up a little bit. My equation is this balance, this cash balance. I add in my deposits in transit. I reduce it by the outstanding checks to kind of get the updated adjusted balance. So that's, I got $18,599. So we've done our first reconciliation. So now we're going to reconcile that general ledger balance that's in QuickBooks to the bank statement and account for all those different things. So the accounting records balance shows a balance of 14,134. So I'm going to put that, so I have another reconciliation down here. Actually, let me just hide this really quick. So the cash balance per the general ledger is 14,134. And then the credit memo is not yet recorded in the accounting system. So that's going to be that note payment that we received. So we'll just say $6,000 plus $55 of interest that we received in our bank account. So there's that. And then our debit memo is not yet recorded. So that's going to be a service charge of $40 plus the utility bills that we haven't recorded in our QuickBooks account yet. And so that is 1,550, and that gives us an adjusted balance of 18,559. And cool thing here is, and hide, we've got this reconciliation here, and we have our adjusted balance of 18,599, and we scroll down, we've got that same thing right there, 18,599, and I just put in a little check to see if these tie out, and they do. So that's a really simplified methodology for approaching that bank reconciliation. And now David will walk us through sort of how to access that bank reconciliation module within QuickBooks, which, trust me, is a lot easier, because the way that you gather the information that's presented in this problem is by going through and looking at the line items in your general ledger account and looking at the line items in your bank statement and seeing if they match. And that's how you're able to find all these different things, these reconciling items, if you will. So QuickBooks has a really great way of bringing those in itself. So you need the actual bank statement, but they've got a wonderful module here.
Can you see my screen, Juliana? Just confirm.
Yeah, your screen showing.
Okay. To get to the banking module in QuickBooks Online, you can go to the gear icon on the far right, go to Reconcile, and select which cash account or credit card account you want to reconcile. So let's go with the checking account. So this account has already been reconciled. You can see the beginning balance, 5,000. So last month's reconciliation was already done. I'm just going to throw in a number right here. So let's assume 10,000 was any balance for the current month.
And that would be what shows up on your bank statement. That's
Yep.
the ending, yeah.
Let's say we're doing August 31st, 2020. So it brings you to this screen. Let's see. So pretty much at the top here, it says, so it's 10,000 with the ending balance according to the bank statement. And the amount that cleared in the current month was 5,000. And how they got this 5,000 was beginning balance, the difference between the beginning balance and the ending balance. So it increased by 5,000. So when you go and reconcile, you can see here, these are all the transactions for that hasn't been cleared yet for this checking account. So you can see we got the payment amount, the amount going out, and these are deposits, money coming in. We've got the date of the transaction. So pretty much when you grab your bank statement, you go line item by line item, start from the beginning. So when you grab your bank statement, look at the deposits first, see which deposits cleared. So if you cleared the bank and you see it in here, let's do an example like this first one. Let's say it's 175 cleared in August. So let's click this 175. When you check it, you're marking it as cleared. So you do all the deposits, the ones that cleared. Then you move on to the payments section, this column right here, and go through each one, see which ones cleared the bank, and mark those as cleared. And after you cleared all of them, or if maybe some of the bank transactions that didn't clear the bank, you will need to enter those in here. You can either go to the banking module here, go to banking, and if your bank is connected to QuickBooks, you can add those in there. You should probably do that first before you start the bank reconciliation process. So yeah, so your main goal is to get this difference down to 0. So once it's to 0, your account is reconciled, and any items that are not checked, those are either outstanding checks or deposits in transit. And make sure those are accurate. Maybe those checks were never sent out, or deposits were never occurred, or you never received them. Yeah. Anything else?
If I could mention this, the bank reconciliation process is a really important tool for any company, and it is very necessary because it also helps provide a level of control. You don't want anybody taking out funds that shouldn't be taken out. You don't want someone who has access to a debit card buying things that they shouldn't buy. And this is forcing accountability for every single banking transaction. So just so you understand, another really great thing about this bank reconciliation process is, yes, it captures items that you may have missed that hit the bank statement. It helps you identify errors. It's a necessary component of a month-end close process, but it's also really important for business owners and executives to understand that this provides a level of control over people misappropriating funds from their bank account. So forcing some sort of recognition as an accounting entry of all the cash transactions is a really great step to take. That's it. Sorry.
And on a side note, before I forget, after you close your month, there is a setting in QuickBooks where you can close the month with a passcode. So you can't make any journal entries to that month you closed or make any changes. And if you want to make any changes, you'll need to enter. Here's some settings that you can add in QuickBooks. Hold on, I gotta find the password. So let's say we want to close this books, and you can have QuickBooks give you a warning if the month was closed already, or add a password. So only you or your accountant can add a password or make changes to prior months. So that's a side note.
I would also print all of your bank reconciliations and print them to PDF or print them to paper, depending on how you get your bank statements, and store them with your bank statements.
Let's talk about this banking module in QuickBooks real quick. So these are, you can see here, I think I talked about this in my first class or the first session. You can see there's 3 accounts that are linked to QuickBooks. So we got the checking, savings account, and a credit card right here. So these are directly synced with those bank accounts and are updated frequently. And they pull transactions. So down here, these are all the transactions that have synced to QuickBooks but haven't been added to the general ledger yet. So you can select for the first one, so books by Bessie. So the payee was books by Bessie. So let's assume this is subscription fee. So you can choose, actually let's do the payee will be books by Bessie. And the category will be the expense account. So let's do subscription. And add a memo if you would like. And let's say this is a monthly fee, so it doesn't go to prepaid. And just click add. That's it. It's a lot more efficient than posting manual journal entries. Yeah. Let's see. And you can also match for like any bills that were paid or invoices, money received for invoices from customers. If you already marked it as a deposit already in the system, you can match it already. So like you can see this 868 was already recorded. So pretty much you need to double check the payee and the or the customer first to see if it matches and the amount matches. Yeah. Let's see. Anything else, Juliana, for this? You want to add?
I know I don't have anything to add for banking.
Okay. Should we go over, let's go running reports for AR and AP. Is that okay? Yeah.
Yeah.
To run reports in QuickBooks, go here on this far left toolbar, click report. To review the accounts receivable report, when we do our monthly closes, we look at the accounts receivable aging detail. Do that. Let's look at August 31st. Let's pretend we're closing out August. So when I open this AR aging detail, I look for any unusual balances, for example, credit balances or old past due balances. So you can see here, these 2 at the top, these are pretty old. So like June, like 30 to 60 days past due. So you should follow up with those customers. I think we mentioned Red Rock Diner in our previous slide. And contact them for payment or, yeah. For accounts payable, go to reports again and search accounts payable. Just click on the aging detail. Just pretend we're doing August again. So it's the AP aging detail. Look for any old or unusual balances in this amount column right here. This 5650 is old. Maybe follow up with your AP staff to see why this hasn't been paid yet. These ones are getting close to past due. Double check on those. These ones are past due. Check on those as well. Yeah. Let's see, in QuickBooks, there's many reports in here, and I think next week class, Juliana and Josh will be teaching about that.
Something I also wanted to add is when you're putting together these balance sheet reconciliation schedules for your month-end close, a really great start is just looking at the account detail in QuickBooks. I'm just gonna, David, can you press the balance sheet really quick and just show them that you can click and get the details of like any of those?
Yeah, let's look at last month.
Yeah.
So it looks like
it's a useful tool when you're trying to like, what did happen that month? And like, oh, this is actually all of the activity right here. So it'll really help you understand what's included in that $3,329 balance.
Mhm. Is there any questions, Heather?
There is, yeah, no, that's okay. There are none so far. I don't know if anyone wants to ask a live question. You can go ahead and unmute yourself and ask one of our presenters.
Yeah, we have some time because we finished a little early. So if you've got some questions, you want us to walk through something again, this is a great time.
And give everyone just a few minutes to see if anyone does, or if you don't want to ask it out loud, you're welcome to put it in the chat box and I can read it for you. Nobody at all? Nobody has one question for them? I think you guys just explained everything really well.
Yeah, I think they're doing a great job. Thank you, both David and Juliana.
Thanks,
Oh,
It's
Sharon.
our pleasure. Thank you.
I
Or you
guess
guys are
on
just
that
smart.
note, if anyone does have a in the meantime, you're welcome to put it in the chat. We can ask them. They're going to stick around. We'll go ahead. Jessica did say she promised everyone one of those giveaways again today. So she wanted to go ahead and take over. We can do that, see if there's any questions, and we might give you guys back some time today.
Okay, everyone, I'm gonna spin the wheel. Oh, Larry, congratulations, Larry. I would touch base with you to see what kind of marketing materials you would like to choose. We have a card magnet and also fabric masks or business cards that you can choose from. I will be in touch. Thank you.
Awesome. Congrats to Larry. Like she said, go ahead and give her an email, or you can email Lily as well. I suppose there wasn't any more questions that came through, so we might just be giving back some people some time. So I want to thank
Heather,
David and Juliana again for presenting today.
Heather,
Sharon?
yeah, I have a question for David and Juliana. I have QuickBooks desktop, and I tried to go into my QuickBooks, and it opened up a whole new company. So do I need to call them and ask them why that did that?
Yeah, you should have a company file located somewhere on your actual local computer. So
That's what I thought. That's what I thought, and I couldn't.
Yeah.
Right, I couldn't find it, and I was like, okay, why did it do that though?
Yeah. What do you mean by new company? Like it was like a brand new company?
Yeah, it opened up. It didn't let me find my old, files that were backed up on the computer, and it said, "Oh, do you want to open up a new company?" And I was like, "No, I want,
Yeah.
to get into the company that I already have opened." And so,
yeah, contact QuickBooks maybe. See if they can help, and if they can't help, you can reach out to us, and we're able to help too.
okay, thank
Yeah,
you.
if I could suggest trying one thing, when you open up QuickBooks and it kind of gives you that screen and it's like open a new company or open your existing company, but there's no companies listed, I think you can like cancel out of that and then go up to the top where it says file and then try open company from there. And it might actually give you like your drives, like your local computer drives. You might be able to search for it that way. I would try that.
Okay, thank you.
Yeah, and then let us know. I'll be back on Thursday.
Yeah,
I'm going to
call them.
2 weeks. So
yeah. Okay, thank you.
Yeah.
David and Juliana, if there is somebody that wants to switch from, either Excel or something else that they're using currently to QuickBooks or QuickBooks Online, as far as starting out, what would you recommend? Because I know there's quite a bit of things to do. So what would you, is there a strategy that you would recommend that they would start first?
You know, one of the great things about QuickBooks Online, and as soon as you migrate your data over there, you can start with the smallest, and then if you want more options and features, you just upgrade and they're available. I would be happy to email you so you can distribute it, sort of what features the wholesale pricing package offers, but it's very accounting focused because it's what we receive at Clark Newber, so we can pass it on to our clients. But at least it lists out all the features, and so everybody could take a look at it, and they could see sort of what the price point would be on a monthly basis, and if it has everything that they want, because there are different it kind of adds features for if you pay a little bit more every month. But, and I understand that it's hard, it's difficult to think about paying a monthly fee when you've only been upgrading like every other year. But in the grand scheme of things, I would say that QuickBooks is still inexpensive as an accounting software. I think that it's worth it to have the cloud access, and knowing that the data is always backed up and I can access it from anywhere. And if my computer shuts down and I can't get to my company file, that I have a way to get to it from any browser. That provides me with a lot of peace of mind. So it might be something that's worth looking into. A lot of the job costing capabilities, though, I believe are in the Plus package. So that's just something else to think about if you're doing a lot of the job and WIP stuff that Josh was talking about last Thursday. But I can email that to you, and then you can distribute it to everybody. And it's the wholesale pricing that's offered through Clark Newber, but you don't have to be a client of ours to get our wholesale pricing. So we would just set you up with the wholesale pricing and bill you monthly for it, and that would be it. So it's just something to think about because there's a little bit of a discount there.
That's great. I think that I'd be happy to distribute that information to everyone.
Okay, great. I will send it to you tomorrow morning.
All right, awesome. Thanks, guys. Is there any last questions that our presenters can answer? Going once? Twice? I don't believe there are. And if you do have any questions that pop up in the meantime, we will be back again on Thursday. So go ahead and you can table those for then. Or if you have an emergency type of question and you really want to know tonight or you're not going to sleep, you can email Jessica or Lily and they can get you an answer. So thanks again to David and Juliana. And like I said, we will be back on Thursday, same time, same place. So we'll hope to see you then. Have a great evening, everybody.
Thank you.
Thank
Bye.
you.
Take care.
Bye-bye.